Here. Now, we're going to be speaking now to Ben McLannahan. He is from the Financial Times, and he joins us from Hong Kong. So, Ben, the senators in the U.S. certainly ratcheting up the rhetoric. They say, you know, the administration's out of time as far as waiting for China to do something.
Well, that's right. There's certainly enormous pressure. There's been enormous pressure on China for months and months to do something about the peg, which was described as an emergency setting back in July 2008 when it was imposed. And the export figures, as you talk about last week, almost up 50% year on year, suggest that it's time to act now. But in China's defense, it's got at least three arguments that it can use to avoid, well, to resist any significant change on its FX policy. The first is that this is really a regional trade rebound. If you look at Korea, it's up 42% year on year. Japan's up about 40% year on year, and that's despite of two currencies that are pretty strong.
So
the second is the euro, of course.
I was just going to say, so Asia's sustaining its own recovery there.
That's right, yeah. In spite of currencies that are stronger than they'd like. I mean, the yen at 91 is much stronger than the 95 that the government wants. The second, of course, is the euro collapse, which effectively has raised the exchange rate for the renminbi. And the third is this wage inflation, which we've been seeing in recent weeks. That's effectively given Chinese workers an enormous pay rise, and thus their purchasing power has rebalanced the economy. So that is why we're seeing the 12-month forwards collapse in recent months, from about 3% appreciation from the current spot rate to about 1.3% now.
One could also argue, of course, that there's always an excuse to be found when China doesn't want to move on something. But, I mean, the American senators make the point that, you know, China's dollar peg hurts the global recovery. Is that true?
Well, it's always questionable. I think what's hurting the global recovery is the enormous overhang of debt accumulated over the past 10 years, which is preventing consumers from going out and buying, preventing companies from investing.
So then what we need China to do then is to stimulate domestic demand. And the wage inflation, you say, is going to help with that.
Yeah, that's certainly going to help. And if you look at the retail sales figures that you just flagged up, 19% is pretty good in any economy. And it does suggest that a gradual rebalancing is very much underway.
What about the prospects for tightening in China? I mean, you have consumer price inflation above target. They're going to have to do more. What can we expect next?
Well, they've got plenty of tools in the monetary toolkit, of course. They've got the interest rate, the deposit rates, neither of which have been moved yet. Their tightening efforts have been limited to the reserve requirement ratio, which is the proportion of funds that banks must deposit at the central bank. And so it does have plenty of armoury left. And if you look at the CPI figure, 3.1% is above the government's target zone, suggesting it would be uncomfortable if it stayed above this for months on end. But if you actually look at the underlying trend, it's not that worrying. China was deflating into August last year, and if you look at the consumer, the wholesale prices of agriculture, that's actually coming down, food prices, and now that there's been a slight slowdown in property, rental prices should also start to feed through.
Ben McLannahan there from the FT. Thanks so much for joining us.
Thank you.